Let's get across the market open. David Lane joining us from Ord Minnett. David, welcome to Wednesday. Good to catch up with you again. Let's take a look at
Thanks,
what
Andrew.
happened overnight. First, Wall Street managing to gain further, also marking 100 days of the Trump presidency. Of course, that's a hallmark of that has been the volatility that we've seen. But
Certainly has.
markets trying to shake that off, aren't they, at the moment?
Yes, we had a reasonably positive night on Wall Street last night, and the last few days have been a reasonable run for the US. They are in reporting season at the moment, so there's been a couple of positive reports that came through. Honeywell jumped about 5.5% after beating earnings expectations. So there's some individual stocks that have done well. But yeah, certainly a little bit of positivity that we're seeing at the end of that 100 days. But when we look at the first 100 days of Trump 2.0, it's actually the worst market performance for a president since Gerald Ford in 1974, and that was after the Nixon resigned. So, yes, although President Trump promised a massive boom, the market hasn't necessarily reacted that way.
All right, also some signs of weakness and some economic data out of the States too. In
Yeah, very
particular,
much so.
consumer confidence really taking a hit, and also those job openings coming off as well.
Yes, they have. Yeah, job openings down for the March period, but then down about 11.1% year on year. So, indicating a softening in the employment market. Still at very very strong levels. So yeah, we are coming off some highs there. But yes, as you said, the consumer confidence has really taken a hit. The April confidence was down about 8.5% and down about 11.1% for the year as well. So certainly signs in the US that not only consumers but markets are concerned about the impact of the tariffs and the trade war. Obviously, we're in that lull period with the 90-day pause, still around 60 days or so to go of that. So, yeah, markets are still pretty cautious about the fact that it doesn't look like there's been any deals struck at this point in time, and what might happen as far as the reintroduction of those tariffs. At the end of that pause.
What are we seeing with positioning at the moment, with evidence that we're seeing capital outflows from the US and perhaps Australia benefiting as a result?
Yeah, we have. We've seen a lot of the markets outside of the US outperforming the US over the last month or so. And as you said, capital flows coming out. The US dollar has been weaker, not only equity markets but also bond markets. There appears to be a bit of a capital outflow, and even some reports recently that the Australian super funds are re-examining their exposures to the US and down weighting exposure, particularly to those Mag 7 that have done really well, and looking at repositioning. So, as you said, the Australian market seems to be a beneficiary of that. We're now above the levels that we were pre-Liberation Day. So the Australian market has taken it a bit in the stride and seems to be a bit of a beneficiary. Obviously, we're not as big. We're not going to be as impacted as much as many other countries as far as those tariffs are concerned, but certainly we seem to be a bit of a safe haven as far as fund flow is concerned as well.
Well, it's interesting because this comes amidst confession season here with quarterlies coming thick and fast at the moment. Today, we've already had Coles and Westpac.
Yes, Coles actually came out with a fairly solid result. Their sales revenue was quite good, so it looks like we could well see a fairly positive impact from that. It seems that the consumer the essential services are doing quite well in Australia. Conversely, I think Westpac could take a bit of a hit because in their announcement today, they announced a fairly big impact from a hedging issue. So taking a hit of about $140 million to their bottom line. So that's probably come out a little bit out of left field. So we could well see the shares of Westpac and possibly the other banks a little bit weaker today.
What have you seen so far, and have you made adjustments as a result of what you've heard from these companies, particularly in terms of guidance?
Well, I think guidance in general is very, very cautious at the moment, and many company management are talking about challenging times. So I think we are readjusting as far as that's concerned. Since the reporting season in Feb, we've seen a general downgrade of earnings expectations for 2025. Still reasonably positive expectations for 2026, but certainly, there's been a readjustment as far as the expectations across the board in Australia, and it's been interesting because we have come down, but still the Australian market isn't extraordinary value at the moment. So I think over the next couple of months, as the global discussions around trade, etc., continue, we could see more volatility and potentially a little bit more opportunity arising. So, we're still taking a fairly cautious stance as far as equities are concerned at the moment.
Now, data-wise, David, an important one today with the quarterly read on inflation, of course, that's likely to inform the next move by the Reserve Bank next month.
Yes, it is. Yes, certainly very, very important. And we are starting to see inflation coming down in Australia. We're obviously heading into the election on the weekend. Don't really think that the election will have too much of an impact as far as markets are concerned. Neither major party have a reform agenda or anything significant. So potentially the only impact could be if we have a hung parliament. That might be a bit of a negative on the market, but overall, I don't think that will have much of an impact. And more importantly, as you said, the CPI number indicating whether or not we see a rate cut soon or later this year. So, we'll certainly be keeping a very close eye on that today.
Yeah, I mean, how important is that? If obviously inflation falls back within that 2 to 3 band range that the RBA is targeting, what are we likely to see? Is that likely to provide a bit of a boost in terms of share market sentiment, do you think?
Could be a bit of a positive, because I think a rate cut here in Australia in the right environment, will be seen as a bit of a positive. If we get into a situation where there is turmoil with tariffs as we thought that it could have been a month ago, and there's an emergency rate cut, I think that will be more of a concern for the market. But if we are getting a rate cut because inflation is getting back into the band that the RBA is targeting longer term, I think that would be seen as a net positive.